So the next coin down the list is EOS. Now, to better understand EOS, there's a few concepts that we need to go over, specifically proof of stake and delegated proof of stake. Now, I didn't want to go through these theories in the beginning of the class because it would just be too much theory one shot. And I think it would be a better and easier way for us to understand them as we go through these coins that have different technologies and different protocols to learn about those different protocols. So EOS is a platform that wants to let people run large decentralized applications on top of them. So the same sense as Ethereum, right? Where on Ethereum, it's a platform, you can launch your own decentralized app. Same thing with EOS. You can run your own decentralized app on top of EOS's blockchain. And their objective is for you to be able to run large scale decentralized application. Like we've seen with Ethereum, an application like the Kitty application was too big, or the blockchain of EOS couldn't handle all the transactions that were done on top of that token. So EOS wants to solve that problem by having a protocol that enables large-scale decentralized applications to work. The funny thing is, again, EOS started in 2017 by Block One, so about a year ago. When they started, their token was run on top of Ethereum's blockchain. So they didn't have their own blockchain. They ran their decentralized app, EOS, on top of Ethereum's blockchain. And then at one point, January 2018, they came off of Ethereum's blockchain. They launched their own blockchain. And now you can they stopped being a token and they became a coin, right? And now you can run your own decentralized applications on top of their blockchain. So they're a main competitor of Ethereum, right? And the funny thing is that they were on Ethereum's blockchain in the beginning, and actually coming off of it, they were getting help from Ethereum's founder, Vitalik Buterin, even though that they were competitive. And that shows you the type of person he is and how, he just wants to help the space grow. Now, there are differences between Ethereum and EOS, and we'll get into that. But basically what EOS does, they enable smart contracts, same thing as Ethereum. They're eliminating transaction fees, and they're solving the scalability issue that we're having by using a different consensus algorithm than Ethereum and Bitcoin and a lot of other currencies. They're doing what we call delegated proof of stake consensus. Now, to understand that, we need to understand what proof of stake is. We've already seen proof of work, right? And everybody understands what proof of work is. So, look at this. We have a blockchain. So good. So we can actually just go on top of that. So proof of work is when you have, and again, how they invented proof of work? Proof of work was invented for spammers. So there was too many spams. So basically, I think it was email spams, right? So to eliminate that or mitigate that, they had people solve a puzzle, and then they can send the email, and that eliminates just sending mass spam emails. It's the same thing with the blockchain, right? Proof of work is you solve a puzzle, and then you can commit your block. And because of that, we trust you, and it eliminates people who are trying to launch an attack by sending fake blocks. We make sure that the person is actually we trust what he's giving to us because he did a lot of work to give that to us. And we don't just trust them outright. We check with different people and the block has to get better. But, it's still part of the protocol, and it's one of the biggest points of the protocol is having this proof of work. Now, like we've seen, proof of work consumes too much energy, right? And even though it's decentralized because anybody can have a machine, anybody can buy an Antminer, right? Antminer 9S or whatever version they have now, and they can mine and get rewards from mining. It's not as decentralized as that because large companies who are able to buy a lot of these machines, right, and mine, they can then get, a lot of Antminers, Antminer 9s, and then they maybe get the 10, and they have a bunch of them, and they're mining at a very big scale. So they're getting a lot of rewards. And because of that, they can buy these machines at lower cost. They can get better deals for electricity and whatnot. So then you have a lot of centralizations in the mining where people, the biggest people can mine the most and then basically get bigger. And again, it's not that great for decentralization. And if you go for, let's say we get on YouTube here and we check some mining farms, right? Mining farm, crypto, these farms are huge, right? So let's see here. This might not be, a huge farm, but you can see the scale, right? So when you're competing, every one of these small machines is a few $1,000s, and you're competing with companies that are putting in millions and millions of dollars. They're getting a better deal. They're going to be more competitive in mining. And the thing is, all of these machines consume so much electricity, so much power. Is that the most efficient way? So we came up with a different type of consensus algorithm, right? And that consensus algorithm basically does it a bit differently. What it does is, it's called proof of stake. Okay. Here, proof of stake. Anybody can be part of certifying transactions through this model. The only thing you need is a computer, and you need to be connected to the blockchain and put in some money. So you put in some coins. Let's say the coin is MTG coin, right? You go in and you put in some MTG coins. Let's say you put in 1,000. And for those 1,000 coins, you're now part of that system. You're part of the ecosystem, and you can confirm the transactions. And there's a bunch of other people. Maybe somebody has 100 coins here, somebody has 10 coins, and they're all part of the system. So when there's a transaction that comes out, what happens is it's going to be sent to one of these computers randomly. And let's say in this situation, it's randomly sent to MTG, to my computer, right? And I have 1,000 MTG coins. Now, this transaction, I certify it. I say if it's correct or not. And because I do that, it doesn't consume any energy, right? I just confirm it. Now, let's say this transaction was for like 10 coins. I get it. If I lie and this was a fake transaction or a bad transaction and I didn't confirm it correctly, I didn't check that it is true that this signature is correct or whatnot, then the money that I put in here will be lost. I will lose my funds. So I'm staking my money, I'm putting in my coins so that people trust that when I confirm a transaction, I'm saying the truth. Because if somebody else confirms this transaction and then it comes out that I lied about it and it was not a correct transaction, then I'm losing my funds. And I will never get to confirm transactions that are bigger. Well, not the transaction, the reward, right? Because this transaction, there's a fee associated to it, and maybe the fee is 0.01 coin, right? Now, why would I lie to make 0.01 coin and risk losing 1,000 coins? I'm not going to lie, right? So the incentive is as strong, if not even stronger, than a proof of work, because I'm locking in my money in this node, we call these nodes, to certify that I will be saying the truth. Because if I lie, I will lose the funds that are in there, or a big part of the funds, right? So it's very safe. And then in this way, people are going to get coins or get transactions to confirm randomly based on the amount of coins they have. So if you have 100 coins, you have 10 times less chance of getting a transaction, but that's fair because this person has 10 times more, he should have 10 times more chance. It's a linear relationship. The more coins you have, the more chance you're going to get of confirming a transaction, right? But when you're doing proof of work and you're mining, the more money you have, you actually start making way more money. Okay, it's not linear. It looks more like this because of the economies of scale, right? So this is actually way better. Now, Ethereum, for example, even though right now it's running a proof of work, algorithm, Ethereum plans on going proof of stake. Now, a lot of people aren't happy about it because they're miners and they're making money out of the mining and they don't want that, but it just makes sense, right? It makes a lot of sense. Now, even with this, there's a lot of issues. Why? Because there's so many nodes. There's so many people that stake their funds and that mint these blocks. So when we're doing proof of stake, we don't call it, when we're doing proof of work, it's called mined. We're mining blocks. Here it's called minting. And that's just terminology. So when we're minting a block, there's so many of these. So we have to send the transactions to a lot of nodes, and it does take time. So what EOS came out with, and I think EOS should be, so what EOS came out with is basically, and they're not the only one who are using delegated proof of stake. I believe there's Steam that is doing that as well right now, and a few other coins. But what they're saying is, you know what, instead of having all these nodes, let's have, 21 nodes, just 21. And these nodes will vote them. So if you have any EOS coin, you can vote for who you want to act as a witness and to confirm these transactions. So it's like a democracy where people can vote, EOS holders, they can vote for who represents them and who they trust to confirm these transactions. And the voting is ongoing. So if somebody becomes less trustworthy and people vote for somebody else, he can not be there anymore. He will no longer be part of the system, and somebody else will come in his place who will have more votes than him. And the top 21 people will be the 21 nodes that basically can confirm these transactions. Because of that, because there's way less nodes, we can confirm way more transactions way quicker. So I think what EOS is saying is that they can get up to 1,000 transactions a second, and it takes less than half a second, so 500 milliseconds to confirm a transaction. So that's ridiculously fast, right? Or to mint a block, sorry. So that's ridiculously quick. Now, EOS gained a lot of popularity with this, and everybody saw that it made a lot of sense because it solves some of the issues, right? It solved the issues that we're having with scaling. And not only that, but they had a lot of very nice and cool projects that were coming out simultaneously. So if you go on EOS projects, if you just check all the new projects that are coming out on top of the EOS platform, you can see here we have some education, decentralized applications, advertising, gaming and gambling, payment and currency exchanges, privacy securities, platforms. So you have a lot of coins that are already, a lot of tokens that are going to be launched on the EOS network. Amazing, right? And the price of EOS went up accordingly. So let's see EOS right now. So EOS up 5% today, but it had, some ups and downs. So if we look at the price of EOS, and we're not even going to look in January where we had the huge market going up, but let's look at after that when the market was dropping. And I don't want to say that April was dropping, it was going up a bit, but EOS went up from $5 within a few weeks all the way up to 22, 23 bucks, right? So it did more than 400, quadrupled within a week or a few weeks. But then it dropped all the way back down to 5, right? So it had this move up because everybody was pretty excited about all of this new tech and learning about it and saying, okay, well, that's going to be the future. But then we started getting articles about the negative sides of this, right? And the negative side of this is that you're giving away a lot of the decentralization that we like, right? So, and I'll get to that in a few seconds. So basically, that's what proof of stake is, and delegated proof of stake. Proof of stake, you're basically staking your funds, and because of that, You can lose them if you're lying, and we trust you because we know that there's no incentive for you to lie, and we'll catch you if you lie anyways because we are checking with several people, but it's still slow. There's so many nodes. Decentralized proof of stake reduces the number of witnesses in the nodes who can confirm the transactions. We can vote for them, but it's way faster because of that, but it reduces on decentralization. So yeah, EOS enables smart contracts, does this. They have 21 block producers that will validate blocks in 500 milliseconds. The protocol, delegated proof of stake, half a second block time, 21 block producers. Voting for block producers, each EOS coin has one vote. The cons of EOS is that it's less decentralized. And because it's less decentralized, these 21 block producers, they have a lot of coins, right? And because they have a lot of coins, they have a lot of voting power. And they can help each other out in a way of who they can vote for each other. They can do things that, there's a high potential for collusion, basically. And that happens in every single business, every single industry that's not governed by by a government entity, right? If you're not governed, you are gonna collude because you're human, right? Regardless of how good you are, regardless of how good-hearted you are. Maybe not everybody. Some people are just so good, but most people aren't, right? So if you put somebody in this position of power, they will try to find a way to better themselves off. And because of that, there came out a lot of articles talking about how these people can help each other out and they can, push other people down and whatnot. So I'll let you read more about it. But it came out to be, yes, we are solving one issue, but when we're solving one issue, we're giving away part of something else, right? And this is where we're at now. If we want faster speeds, we have to give away on something. And what do we give away on? Do we give away on decentralization? Do we give away on security? If we want more of that, then we have to be maybe slower. And it's a give take. Now, all these technologies are getting better. Again, this just came in several months ago. It's a new thing still. And we constantly come out with new technologies and new protocols, and it's constantly going to change with time. So what you have to understand from this is basically, as an investor, these things will have a big impact on your coins. And as you are investing, sorry, let me just take this off. As you are investing, what's going to happen is basically you're going to have to understand what protocols your coin is on, understand if they are going to change, because a lot of these coins go from one protocol to the other and they change. Understand as well if there are new protocols or new technologies that are coming out in the cryptocurrency ecosystem and what they will do, which coins will be implementing them, because that's the difference between, making huge amounts of returns and losing huge amounts of returns. EOS, for example, because we're basically full-time, I have a full-time trading company, right? So basically we have traders who trade full-time and they're not just investing, but they're also trading as well. So their eyes are always open on the news. We had EOS because of all the hype. We've sold it around the $20 range as there was a lot of articles starting to come out on the negative effects of this, right? And this is why it's also important to understand these things, because that saved us a lot of money, because we got rid of our position, because we're like, okay, well, right now there's all these issues that are coming out with it. It's time to get out. We might buy it back later. And I'm not saying it's a bad project. They have a lot of amazing coins, tokens that are going to be run on top of them. And you know what? They're going to be able to handle large-scale decentralized apps. Nobody else can handle that at the time being. So, give and take, right? But very important to understand these protocols and to know what's going on, because it's going to have a huge money impact, financial impact on the currency you're holding.